What's going on, traders? Welcome back to my YouTube channel. I'm finally back, and I do apologize for being away, but it is what it is. Sometimes we're able to crack on with our work, and other times we need a little bit of rest. But this time, I am going to be doing my very best to record on a regular basis and make sure I'm providing content for you. So if you saw yesterday on my Instagram, I put out a post and I mentioned that, or I asked the question, what do you want to see? And I've got over 400 responses or thereabouts. So I'm going to do my very best to action them and provide you the content you're looking for. But this time around now, I think I'm going to deviate a little bit from price action, because I think the channel itself provides anybody who comes to the channel, whether you're new or old, an opportunity to adopt an approach to the market that suits you best. This time around, I'm going to be talking about more the psychological aspect, the technical side of trading, and just really the real truths about becoming successful and consistent. So today I thought I'd talk about entry rules, as you can see in front of us. And I thought I'll do this in three categories. First, looking at retest traders, what we want to be looking for in terms of entry rules, breakout traders, and then looking for reversal traders. Now, obviously, there's so many different variants to this. And as you probably all know me very well, I am a price action trader. So I'm going to just be focusing on clean price action. But the free trade examples I'm going to share with you today are from my students. And the trades were taken today. So I'll be able to show you not so much on a replay mode, but more so from an actual trader's perspective and how you might want to be entering trades based on these free trading concepts, approaches, strategies, whatever you want to call it. Focus on the nitty gritty here, not so much the perfection of the strategy itself, because it's the thought process that you want to adopt that's going to help you to become consistent and profitable in your trading, not so much having a perfect strategy. So everybody, let's get into the video. I just want to say welcome back. Thank you for supporting the channel. If you're new, make sure you're subscribing to the channel. Quick click below. Like the video for me, guys. Let's get this over 1,000 likes, and turn on notifications, because I'm going to be posting regularly. And I hope you're looking forward to the content as much as I'm looking forward to producing the content. So let's take a look at entry rules. Now, there are so many different ways to enter the markets, guys. And I'm going to tell you now, every single one of you, there is no perfect way whatsoever. Don't let anybody fool you out there. I don't care whether it's your granddad's guru or your 21st century guru. Let me tell you now, there is no perfect way to enter the market. The only way you're going to become successful and consistent is if you have impeccable risk management. That is it. You can enter the market by flicking a coin every single time you decide to take a trade. As long as you're using good risk management and you're using a good risk reward ratio, you'll be a profitable trader. It really is that simple. The only thing is, based on what we do in terms of strategies and how we approach the markets, is we try to fine tune what we do so we can increase that edge from being 50-50 to maybe 55%, 45, or 60-40. Or 70-30. And then once we do that, then we obviously start to identify repeatable patterns that have higher expectancies of winning. And then we can then decide how much we're planning to risk per trade, how long we can hold a trade, etc., etc. Other than that, guys, there is no secret sauce out there. Don't let anybody tell you that. There is no secret sauce. It's all about risk management. But what we're going to define today, or go over today, is 3 variations that you can focus on in order to get into some trades. So now, what is a retest trader? Well, you should all know a retest trader is simply a trader that identifies a key level in the market that is broken, and that key level then acts as a resistance in a downtrend, looking for continuations, or if we're taking buys in an uptrend, that level that has been broken acts as a support in anticipation of a continuation of that uptrend. That is all retest trading is. Now, there is some traders out there that like to trade retest differently, and a lot of them are looking for price to retest a key level in anticipation of the market continuing higher, or they're looking for the market to create retests at the top in anticipations of price continuing lower. Now, this is not a retest at all. This is price failing to break a structural high or a structural low and then reversing. So nowhere in this title do you see the word reversal. It says retest trader. So the first thing that you're looking for as a retest trader is you're looking for a clear trend. It's that simple. If you can stick to clear trends as a retest trader, you are going to increase the likelihood of your success dramatically. It's only when you start to combine the retest trader mindset or approach with the reversal trader mindset approach that you're going to start to add confusion to your trading, and subsequently you're not going to see the results as you want to see them. The next thing that you need to be looking for as a retest trader is not only clear trends, you also need to identify that price leaves the structure for a period of time. What you will find with traders is once a key level is broken in the market, they immediately are looking for any sign for price to come back to this level to look for a trade in order to short it. What they don't do is they don't leave the market or allow the market to breathe and create the push phase, which becomes the lower low, and then pull back to make the retest in anticipation of the continuation down. That's what we're looking for here. We want to identify price clearly leaving the level, creating a little box around it, coming back to the level, creating the retest, and then seeing the market go down. In that way, you have market structure pushing, creating the new low, pulling back, and then showing signs of bearish behavior by price not breaking back through that level with the bullish behavior that's just come into it. Then you anticipate the continuation down. Whereas traders are taking trades like this, where price just simply breaks, comes back immediately. What kicks in? FOMO. They take the trade and then they realize that price just breaks out and breaks back in and then continues up or reverses. So don't be that trader. Allow the market to leave for a period of time, then retest, then look for your tradable opportunity. Now, as I mentioned, the deep pullback is identifying price leaving for a period of time. We kind of accumulated those two together, I guess. But one tip that I want to give you is if you cannot clearly put a box between the breakout and the retest, then you do not want to be taking a trade. Any breakout that breaks out and just comes back like so, or just breaks out and then comes back to retest just like so, you want to be avoiding this scenario and this scenario at all costs. You want to see price leave, come back, then retest the level before seeing it continue down. The next thing that you want to see as part of a retest trader, so we've already identified very simply, and these are simple rules. Whoever came here for the Holy Grail, you're truly mistaken. As I said in the beginning, there's no such thing. Focus on the simplicity of trading. We want a clear trend, a clear breakout where price leaves, price pulling back deep enough into the level. So we want to see price creating what we can visualize as a potential box formation. And what you want to wait for the market to do is pull back deep into the level. Do not take trades here. Do not take trades here. Do not take trades here. Let the market pull back deep into that level to look for those trades. The next thing is you're looking for wick rejections. This goes without saying. A key level when looking for sells, you want to see multiple wick rejections, minimum of 2. When looking for buys, you want a minimum of 2. There are occasions where you look for 1, and there are occasions where there'll be none. But if you are starting out, you're still looking for that consistency, focus on looking for a minimum of 2 wick rejections for sells and 2 wick rejections for buys. The last thing that you want to be looking for as a retest trader is once price comes back to that key level, if you don't get the wick rejections or the indecision candles, or you do, you always want to wait for price to create the momentum. So if you're looking for sells, you're looking for a strong bearish candle to the downside. This is what initiates the bearish move, and this is what gives you the opportunity to take the trade in line with the behavior of the market. The same with buys. If the market is pushing bullish, you want to see the market come back into the key level, provide those wick rejections or indecision candles, and that bullish candle to initiate that bullish behavior in anticipation of a continuation. So that's how we're going to look at retests in terms of retest trading, some of the entry rules. Let's take a look at an example that happened today. So here we have an example on Euro USD on the 15-minute time frame. Now, I'm not going to add too many confluences to this because I really want to make it simple, but this was a trade that one of my mentors took today, or thereabouts actually. And this is a trade that we discussed on our live trading session. Now, the trade that was actually taken was a breakout trade, but we're not going to discuss that. We're going to discuss the retest here and what you're going to identify as a clear trend. Here we can clearly see that the market structure is pushing bearish. We have a break here of 1874 that's clearly broken. Price leaves it for a period of time and then eventually comes back to the key level. Now, remember, I said you want to visualize that box formation between the retest to identify that price is clearly left. You also want to identify price coming deep into a key level. And then you want to identify those wick rejections or the momentum candle to initiate the bearish move in anticipation of a continuation of that bearish move. You can clearly see that's what's happened. And then we have ourselves this morning based on dollar strength, euro weakness, intraday trend down, nice break, price leaves, creates that box formation, comes back as a deep retest, creates the bearish momentum in anticipation of a continuation of that bearish momentum. And this morning, you could have had yourself a beautiful 1-to-3 risk-reward ratio trade. So that's the first example based on retest. Consider those rules and follow them. And I can promise you, you will find success as long as you're sticking to your rules. The next trader we're going to take a look at is the breakout trader. Now, most people don't like breakouts because you will hear in the Forex industry a lot of people saying, stop hunts, market maker, a broker stopped me out, institutions know where my stop loss was, all of that absolute la-di-da. So you'll probably find less breakout traders in this industry than you should find. Because if you do some research on the history of trading, a lot of traders were breakout traders. But there you go. In terms of breakout trading, it is, in my opinion, one of the most efficient ways to trade in the market, along with retests. If you can combine the two together, you're laughing all the way to the bank. If you're afraid of breakouts, then just let it go. It is what it is. But for those that are interested, here it is. Breakout trading simply is identifying the behavior of the market plus the structure and then looking for strong levels. So if the trend of the market is pushing bearish, the only time you're looking for a trade is when the market breaks a structural low or the market, literally breaks a structural low. Now, it's going to come in one formation more often than not, okay? Price is going to pull back before it breaks out. It creates the new lower high in a downtrend. And then what you anticipate after a lower high is made is the lower low. So your breakout trades are going to come from these levels here. All you are anticipating, traders, bear this in mind, is price making a new lower low. That is it. If the market is in an uptrend, all you're anticipating is the market eventually to make a new higher high. Your breakouts are going to come from this level, again, in anticipation of a new higher high. So what you need to be visualizing or identifying in the markets is strong bullish structure. And then in the lead up to the breakout level, you want to see strong behavior. How to identify strong behavior? You're looking for strong green candles in an uptrend. If the market is in a downtrend, you're looking for strong red candles. Once you have those levels, you're then going to identify an area just below or just above where you want to see the market break to show confirmation that the momentum's in play and execute the trade. I'm not going to talk to you about stop losses at all today, but this is how you're going to be looking at it. The next thing you need to see is strong momentum. Now, there's two ways you can identify strong momentum. You can identify strong momentum from a higher time frame confluence. So let's say we're using the 4H time frame and we're using the 15-minute time frame. Let's say this is a 4H candle pushing bullish here. This is going to be reflective on the 15-minute by looking like this. If price is just about to break out of a previous bullish candle and the current bullish candle is pushing, then this is going to be illustrated by bullish candles here on the 15-minute. We know we're expecting the higher high. The current 4H candle is bullish, current behavior is bullish, and then this is added confluence to then take this trade up in anticipation of the new higher high. Look for that strong momentum. Make sure the behavior on the higher timeframes is reflective on the intraday timeframes, and then look to take that trade. Final thing you want to take into consideration is the range. There are times that breakout traders will take trades and they will not be considerate of data to the left. If there's multiple wick rejections here, there's a high chance that once price breaks out, it's going to find a resistance and then it's going to retrace. There's also going to be times where you take a breakout and then there's going to be a level just slightly to the left where price has created a new lower high as part of the downtrend and price is not going to break it. You want to make sure that between your breakout, which is this, and the highs of the structure, there is enough range to make sure you can manage that trade to at least break even, or in most cases, look to take profit. If you do this, you incorporate a good strategy along with good risk management, and you have a clear directional plan of how you're going to execute and manage that trade accordingly. Let's take a look at an example today. And again, this is a trade that one of my students took. Let's take a look. So this is on Aussie dollar USD. Now, what we identified this morning was that the dollar was showing signs of strength. Here you can see that from market open, we had strong bearish movement down, and then we can see the market continue down. Actually, this wasn't a trade that my student took, not this one. It was on a different pair, USD Swiss franc, but never mind. So this is just an example of today's trade. Now, what we're identifying here, and this goes into the reversal patterns, but we identify a trend up. Price breaks that trend to initiate bearish behavior. We then have our first signs of a structural high and a structural low. We then have our signs of a lower high. Once a lower high forms as part of a downtrend, we expect a new lower low. So with that information said, we have options here. Two options to take this trade, and it's really up to you. And I'll let you obviously figure that out as you go along. But the first way you could be looking to take this trade is on the immediate breakout. And how you would do that is you identify the behavior, which is multiple wick rejections, bearish candles closing, and then you'll identify an area where the market is rejected previously, like a low, the current status of the 15-minute candle, which is currently bearish, and then you'll look to place your stop loss in a safe place above a lower high or a key level, and then you'll look for your targets like so. This is what we call a more aggressive entry, but at the same time, it's still not incorrect. You get 2R out of this, and you're entering with the behavior and momentum and structure of the market. If you're not the type of trader that likes to enter based on immediate movements or breakouts, then you can wait for the closes. Here we have a nice bearish close, indicating a breakout of a key level in line with the trend and now behavior of the market. And then you can enter the trade again with your stop loss above the key level, above the current candle, above the lower high, wherever you want, and then target the lows on the 15-minute time frame, or whatever your entry time frame is, or your higher time frame lows. It really is up to you. Here we get 1.5R out of the trade. This is what you want to be looking for, take into consideration the points, and this is the trade idea for breakouts. The final trader we'll take a look at is the reversal trader. Now, I'm not a big fan of reversal trading, and I don't promote it, especially to traders who have not yet mastered retest trading or breakout trading. These are actually in order, and I would say that most of you should be focusing on this first. This, when you become more consistent and profitable, and you have impeccable risk management, and this finally, if you really need to. If not, let it go. But I know there's a lot of reversal traders out there, so I'm going to teach you the right way to do it. As a reversal trader, you're only looking to identify one thing. That is price switching from being in a downtrend in anticipation of a new uptrend forming, or the price reversing, or the market in an uptrend where price is now forming a new downtrend or reversing. That is all you're looking for. There is a couple ways you can look at this, and in my head, in my opinion, should I say, this is the most powerful way. And what you're looking to see is the market fail to break structures first. So let's say the market is in a clear downtrend. You have a level where price creates a new lower low. What you anticipate the market to do is create a pullback, lower high, and then continue down. However, in order to identify the first signs of a reversal, what you want to be looking for is you want to see price failing to break that level. This is not a retest, remember. This is just a sign that price is failing to break that level. If price comes back to this level, the reason why it's not a reversal just yet is because this level still counts as being a structural low, and this potentially now will count as the double top continuation. So to avoid the double top continuation, what you want to make sure is that we have the evidence that price is failing to break, which is this point here. And the next point you need to look for is a structural break. So price is failing to break the lows in a downtrend. Now we have a structural break, but we want validation of that, and we want price to break above this structure. Now we're starting to identify a potential reversal in the market. We haven't taken any trades yet because we're not rushing into the market, but we are identifying that the trend is potentially changing. We have a structural change, which is our third point, which is clean structural development, which is a structural low, structural higher low, and now a new higher high. We now also have evidence here of our trend line break. So this is a structural break plus our previous lower high break in. So this is now indicating bullish behavior. And then what we're looking for the market to do is come back to the key level to show signs of wick rejections, which is the fourth point, and then momentum, which is the fifth point, showing signs that now we are potentially going from a clear downtrend to price failing to break the structure, to our lower high being violated, trend line being violated, new higher low being formed, new structure coming back to key level with wick rejections and momentum in anticipation now the higher highs are going to be formed. I know that's a mouthful, but you'll have to watch that over again. And I'm going to share an example with you today of a trade that one of my students took for sure. So here we have Euro Yen. What we have here from an intraday perspective is a clear downtrend where price is making new lows. We have breakout trades here. We have trends where the market is trending down. We have an area here in the market where price is failing to break below. Here where the double top forms, but now we have a structural change where the new uptrend is forming. You have price creating new higher lows, breaking out, and now we have the retest of structure with multiple wick rejections, bullish candles, and then we're taking the trade in anticipation that the market will form out of this downtrend into this new uptrend and eventually make this new higher high. So here we have the examples of 3 entry techniques you can be using for retest trading, breakout trading, and reversal trading. I really do hope you've enjoyed this lesson today. I'm sure you would. Very powerful tips here for you to adopt. Whether you're a retest trader, breakout trader, or reversal trader, the number one thing you need to consider is to keep things simple. You only need to let the market breathe, and then when it's your time to enter. Not fight the market continuously and chase trades, etc., etc. Just be patient. Make sure you have your rules jotted down, follow them. And as I said, there's no secret sauce, no holy grail, no one way to make money in this market. But the only way to survive and have sustainability for the long run is to make sure you're using impeccable risk management. So if you enjoyed this video, smash that like button for me, guys. Get me to 1,000 likes, please. Turn on notifications, subscribe if you're new. And until next time, continue to trust the process.